Right, I think we've started. My former boss, Martin Wolf, is already saying terrible things about my early years at the Financial Times. I think we have the distinction, I've just discovered actually, that everyone here is an economist. So I don't know whether that fills you with fear that we're not going to reach any firm conclusions, or will feel that it's a breath of fresh air compared to all the political nonsense that happens in other panels. But we're talking about the European recovery. How strong is it? Is it, as many leaders have been saying this week, giving us a window of opportunity to fix things that need to be fixed before the inevitable next crisis, or at least inevitable next recovery, happens? And we have a great cast, not just economists, but now doing other things as well. So Kees van Dijkhuizen, Chief Executive of ABN AMRO, Martin Wolf, my former boss, Chief Economic Commentator for the Financial Times, and Pier Carlo Paduan, distinguished economist, but now sadly having to perform as Italian Economy and Finance Minister, or very happily for the rest of us who want to see good economists playing these roles. Maybe I'll start with you, Minister. If a classic view of Europe at the moment would be, it was the great upside surprise of last year. It was one of the things that contributed to the strength of the global economy last year, that we saw not just a decent recovery gaining steam in Europe, but perhaps a slightly broader one, and one with slightly more momentum than might have been expected a year ago. Now we're wondering, I guess, can it last? But perhaps more importantly, how far have we got in trying to fix the problems that could take us right back to another crisis once we have that cyclical downturn? Because much of the recovery we've seen has clearly been quite cyclical. So how do you see it?
Well, certainly figures do confirm that the recovery is strong. And the real question is, as you put it, is that really just cyclical, or there's something more that therefore would provide with some robustness going down the road as cyclical weakness comes in and perhaps the stimulus is taken away? I have no answer. I have an optimistic conviction that there is some structural element in the recovery in a number of countries, but certainly I would agree with the common wisdom that now permeates debates in Europe, that this is a window of opportunity. It's a window of opportunity for two strategies, not just one. One strategy is about making the recovery more structural and more robust. And there we have to start from a simple and well-known fact, that growth in the future of Europe will not depend on demographics, which are working negatively against growth, but it will work thanks to productivity and innovation. And Europe has a lot to do in terms of having a single strategy towards innovation, new technology, new skills, which is being pursued so much at the national level and not enough at the European level. So there is an opportunity there that needs to be exploited. The other one is about making further progress in the architecture. And there the agenda is, it's a bit more precise. The agenda that, for instance, the leaders have given to finance ministers in the December summit, and will probably be confirming it in March and in June, is that there are a number of issues which need to be addressed. The Commission, indeed, as you know, put on the table a very ambitious program in December. However, the common view is that there are two items which needs to be addressed: completing a banking union and dealing with the ESM, the European Stability Mechanism, which in the view of some should become one component of a common fiscal capacity. So these are ambitious goals. But I'll stop there, because beyond the fact that there is agreement about completing the banking union, there is still a lot of disagreement on how to complete it, and different views across the board of not just the Eurozone members, but the European Union members on how to move forward.
Well, I'll put it sort of directly to you, but then I will also, we'll have follow-up, because I mean, Italy is in a particular position here that at least the impression we had from the conversations around the fringes of the summit between President Macron and Chancellor Merkel, who we just heard downstairs, and also developments since then, the coalition agreement in Germany, suggests that there may be a stitch-up, that the French and the Germans will, we perhaps feel they will reach an agreement that comes somewhere in the middle on the risk sharing and risk reduction proposals, and maybe Italy doesn't get to have the kind of say it would like to have on those issues.
Well, I'm sorry to disappoint you, but Italy is very much in that debate. Of course, the Franco-German relationship is well established, it's even formalized, and it works well. And when it works well, this is good for Europe. But on the discussion of what to do with Eurozone and EU economic architecture, there's been a lot of discussion, including with Italy. And we are trying to find a compromise between, you name it, risk reduction and risk sharing. My view is that both elements should be part and parcel of a new architecture. And although there is still some countries, notably Germany, that says, first of all, let's move forward with more risk reduction before we go to risk sharing. And the answer that others do offer, including France and certainly including Italy, that the amount of risk reduction that has been achieved so far is very large. And indeed, I'm not disclosing any secret in saying that at the ECOFIN we had yesterday meeting in Brussels, there was a formal request to the Commission to provide evidence of this fact. Sometimes the debate in Europe is about headlines and it's not about facts. So we need to take stock of what we have achieved, and we have achieved a lot. I'm moderately optimistic that soon enough we will be reaching a situation by which a banking union will be definitely finalized.
Martin Wolf.
So let's focus at the moment, for this stage, if I may, just on the current economic condition of the Eurozone. I'll just talk about the Eurozone, and then perhaps later come back to the structural reform agenda. I think the fact that this is a fairly modest audience suggests that people have decided that Europe's fine. There's nothing to worry about. And that's a good thing. I was thinking when I was going to introduce my remarks is to think back 6 years to 2012. And there were many, many people here. I went around, I've been here every year for 20 years. And at that stage, I met lots of people who were really wondering whether this thing could hold together at all. And we know the conditions. In early 2012, just after Mario Draghi took over, before he announced the whatever it takes, before the OMT, before the whole, it was just after the very first LTRO, if I remember. And where we are now, by those standards, looks miraculous. So they have eliminated the extreme risk spreads. They have, therefore, made government debt markets manageable. They have achieved a remarkable progress, though not complete, in making the banking sector look sustainable and reducing, because of that, what they did in debt markets, the doom loop relationship at the moment. Come back to that. And since 2012, that is 2013, 14, 15, 16, 17, and I had this chart, actually real GDP in the Eurozone has been rising in line with real GDP per head in the US, which I think most people don't know, but is worth stressing. Of course, because it had a 5-year crisis, not a 2-year crisis, it's way behind relative to the starting point. But I think we have to say it has gone much better than many here feared. Why? I think basically for 2 reasons. One, the central bank, in my view, did the job a central bank had to do. I'll come to this in a second. With remarkable political and technical skill, and that therefore I trust them to continue to do so. And second, governments did enough in the end to make the system work through the emergence of the ESM, reforms and so forth, because it became obvious to them and everybody else that breakup was absolutely impossible. And they eliminated from the markets the breakup risk sentiment. So where are we now? We've had a very strong, the cyclical recovery has been going on for 5 years, but it's now strengthening very considerably. How much further has it got to go? And then I'll talk very briefly about the ECB normalization. How much further has it got to go? If you look at it as a cyclical recovery, aggregate Eurozone unemployment is still significantly, though not massively, above. So I think it's about 2.5 percentage points, I don't know the exact number, above where it was before the crisis. And it wasn't overheating then. So there's no reason in that why it shouldn't continue to fall. There's still cyclical capacity. The problem, of course, and this is very difficult, is the cyclical capacity is not evenly spread. It is very large in, say, Italy, and probably negative in Germany. So that creates the first question. How do you, and to do that, make that work, you need quite powerful adjustment mechanisms in the Eurozone. To put it bluntly, Germany has to get more expensive because that's how the adjustment process works. And quite understandably, Germany doesn't want that to happen. That creates a big problem for monetary policy. On the structural side, even if they got back unemployment to where they were before the crisis, it's still rather high by, say, US standards. They've got another 3 percentage points. So they ought to be able to change the labour market sufficient to get unemployment down to 4% in the Eurozone. If they did that, then they've got at least 2 or 3 more years of growth. And then finally, productivity growth has been very low. And if they do decent reforms and raise that, they could do really well. So the capacity for the cyclical recovery to continue is there, and the structural improvement could be very, very large. Will this happen? That depends a lot. I think finally the ECB should be pretty relaxed about the tightening schedule, though that will be very, very controversial in some parts of the Eurozone, and those divergences are big. Because they haven't hit their inflation target for years. On their own forecast, they're going to continue not to hit their inflation target for years. And that suggests to me that there's a perfectly good reason for withdrawing the expansion slowly and allowing the cyclical recovery to continue. Will they be able to do that? I think that's a very big question on the macro. So that's sort of where I think they are macroeconomically.
And you'll notice I didn't actually ask Martin a question because I knew he would just say whatever he wanted to say in response to the first. But I now will ask you a question on the macro point, because I think there's a couple of levels of this. There's kind of is the recovery looking by European standards great? Yes. Does it need any additional support? No, clearly. And that's actually, it's, as you say, it's not been that long since we've been able to say that. We've had the ongoing debates about whether more support was needed. But the other question, which I guess some people in the markets would have, or many of the commentators would have, is it strong enough to withstand the kind of normalisation path which maybe Mario Draghi might not favour as his first choice, but others in the ECB will now press for, given the absence of alerts and concerns? You know, is it looking so strong? You know, what is the risk if the ECB ends up going a bit faster than the relaxed path that you're suggesting?
We don't know. I'm assuming that they're continuing with asset purchase. So I believe they've halved the rate of it. Significant rises in interest rates. They might knock off the negative rate. I don't think that matters at all. Significant rises in interest rates are some way down the road. In that circumstance, I think there's no problem. If they suddenly decided next week that actually they need to catch up with the Americans and get back to what people think is a reasonable level of short rates, and I would guess some people in Northern Europe might think, why aren't they 3%? And they did that in the next few months. That would create, I think, quite a large jolt to confidence, a very large jolt above all, much more important, I think, than the interest rates themselves, to people's understanding of what the ECB is about. What Mario Draghi and his whole team, and a fair consensus have done, is establish the principle that this is very controversial, that the ECB is a central bank more or less like the other major central banks, that views the economy sort of like the Fed does, and pursues policies like that. If they suddenly jumped in this context, when they're nowhere near their inflation target, to a completely different, what you might imagine the Bundesbank might have done in these circumstances, then the markets would say, what the hell is the ECB about? Is this a completely different institution that we don't understand at all? And I think the shock of that could be very, very substantial.
But if you're taking the US example seriously, there was many years where standard Taylor rules, anything else, was saying, you really don't need to have rates this low. I mean, we forget what an outlier the policy of the last few years has been, that the normalisation process has been so slow in the US, and there was considerable debate within the Fed around that, and we know that there was less pressure on Janet Yellen than there may be on an ongoing basis now in the ECB.
Well, we can have the technical discussion. The Taylor rule was saying that in 2007, 8, 9, 10, they should have massively negative rates, which they couldn't do. So I don't mind if they overshot a bit in the other direction, and I actually don't accept this. Okay. The Taylor rule, in any case, is an ex post empirical rule which can't be turned into a normative rule for a completely different set of circumstances. I think we've gone into so terribly caught up in the Taylor rule.
And it assumes a uniform economy underlying.
Okay. So anyway,
it's not the case.
Getting away from I guess my point
is
it could be much harder for the ECB to overdo it in the same way.
The Fed has worked. This is a big point. This is the only big point. The surprises we've had on inflation in the last few years, not in the early years of the post-crisis, have been consistently somewhat on the downside. In the earlier years, the surprise we didn't have more deflation. In other words, what we actually found is inflation has incredible inertia with a tendency to the downside. Obviously, if that suddenly turns out not to be true as the labour market tightens in Europe, then it will turn out ex post that this policy was somewhat risky. I think it's a completely reasonable risk to run, because if that does turn out to be the case, they just have to tighten faster, and it would be quite a happy problem to have. The basic point I wanted to make is in these immense difficulties in trying to understand where we are in the monetary environment and how our economies are working, which is puzzling, as you know, all macroeconomists. The ECB has done a professional job as best it can in very difficult circumstances with an immensely divergent economy, as the ministers just said, and people understand what it's doing. It's done an incredible job of clarifying broadly what it does. It has to stick within that framework if it is to be comprehensible.
Kees van Dijkhuizen, talking from ABN AMRO's perspective and your own perspective, when you hear this discussion and you hear the positive mood around Europe, are you as sort of pleasantly surprised by what's happened in the last year, I guess, is one question. And I guess the other question is, does it concern you? We had a lot of talk about reform and fixing the roof while the sun is shining. There are some who would say that the history of Europe suggests that politicians only do difficult things when they're standing on a ledge looking down. And if they feel comfortable now, are they really going to take these difficult measures?
I was Treasurer General at the Ministry of Finance 2000-2005, and Mario Draghi was the Italian Treasurer. So I fully appreciate his skills. They were around at that moment in time as chair of EC. It was not the Eurogroup, of course, yet, but I remember him being very capable of doing a lot of preparatory work for all the ministers working on that. I'm surprised indeed that we last year had a much better result in the economy as expected. Recovery was much better, also stronger than expected, also for this year. I think it's steady. I don't expect it to be shaky in the short term. But indeed, you're completely right. It is always difficult for politicians to make difficult decisions when the sun is shining. Having said that, let's be happy that the sun is shining, because I agree, Martin, with your assessment that 6 years ago there was a lot of people were afraid how Europe would end, or if it would end, perhaps. There was a big crisis, and I remember once in the 90s I visited the Fed, and someone said to me, it was Lindsay, I think it was, he was a Fed governor, and he said, "You're going to introduce the euro, you know? Do people move from one country to another?" I said, no, not so much. Is there something with taxes smoothening in Europe? I said, no, 1% in Europe we think is already a lot. He said, "I wish you a lot of luck." It took us 100 years and a civil war. And I had to think about it 6 years ago when he said something like that. I thought it was a very pessimistic guy at that moment in time, but he's a very smart guy. Having said that, I think it's now important that more reforms have been done, by the way, which are perhaps not yet appreciated in a lot of countries, especially in the southern part, but also now I think Macron is also promising in France. So I think that's good. And it's necessary because really use the moment today to do further reforms, because this has also a cyclical element in it. I notice in the Netherlands we have now 4% unemployment rate, and then a basic economic law, wage increases, is happening right now everywhere. So that some moment in time will also happen in Europe, which is, by the way, not a problem because it's good. It's also perhaps helps a bit in the inflationary world. So I think it's crucial at this moment in time that we use this good period. And I think that banks, by the way, we have doubled capital more or less compared to before the crisis 10 years ago. The Basel Agreement is there. So I think now, of course, it will be implemented in 5 years and then have a transition of 5 years. But I think in a way, I expect the regulatory framework more or less to be there. And now it will be more about, in banks, IT disruption and the likes, open banking. That will be much more the name of the game going forward. And I think it's important that I agree with also the view that we should try to also finish a banking union. That's important for Europe. Free flows of capital within Europe, liquidity in Europe. That's important to build Europe going further, and I very much believe in that, and I'm happy that that we're in a position as we are right now. But it means less audience. I agree with you, Martin.
From where you're sitting, what are the key things that need to be strengthened? I mean, you talk about banking union, but maybe even within that, what do you think is the most important aspect of that for us to feel a little bit, and certainly from the financial sector standpoint, to feel a bit more confident going into the next downturn? Because this isn't about preventing the next downturn, it's about making sure the next downturn doesn't become another Eurozone crisis.
Correct. I agree, and I think what has happened in the last 10 years is that banks have de-risked. Most banks have de-risked very much their balance sheets. So they are most balance sheets in Europe these days are much safer than they were before the crisis. In banks, there's even people are very risk averse these days, and you see now around banks actually money flowing, which banks don't do anymore. They're a bit more cautious with respect to the risk return at this moment in time and the search for yield in the market. And so I think stress tests have been developed much more seriously, and I think the ECB, by the way, Mario Draghi, not only monetary policy-wise, but also with respect to the supervision and the stress tests they do, and the much more, I would say, much more serious and much more alike in Europe way of supervising is also an improvement compared to, say, 10 years ago.
But it is interesting, though, because it's just a different tone. I mean, there may be some people in the audience as well. If you listen to the American bankers here at Davos, they're all about, gosh, the pendulum has swung too far. The administration's right to kind of question some of these regulations that have been brought in. And why are you Europeans still actually trying to ratchet up further in your approach to non-performing loans or anything else? You don't think that's right. You think it's absolutely appropriate.
Well, I would say not further. I don't make a plea to do it further. I think that's not what I said. So thank you for asking. If there's any misunderstanding there, actually, to be honest, the Basel Agreement. If I look, for instance, at my bank, I have to double my risk-weighted assets for my mortgages, which I think is not warranted because it's based on an American view with respect to mortgages in the US. Has been accepted in the Basel Agreement because of floors, output floors. I'm not very happy with that, to be honest. And we will, of course, discuss this in Brussels going forward. But in general, I would say the Basel Agreement is more or less it's done. The regulatory framework is now there. So now we can look at the future. We know the rules of the game, and I think the US is, of course, a couple of years further. And it's always a more market-oriented economy, but they took tougher measures quite early in the game, and so also look at the Fed, look at where the interest rate is, look at where the balance sheet development of the Fed is. So they are 3 or 4 years ahead, and that kind of discussion we have in Europe as well. Is it not too much? Because this risk-averse approach of banks can, of course, be detrimental for economic growth, that you are not open for business enough. So that is also the other side of the equation, I agree.
Martin, did you want to get in? Well, I was going to ask Minister Paduan, I was just going to ask you, there is a perception that Italy is a little bit on the wrong side of this in resisting some of the tougher measures on non-performing loans, at a time when we perhaps, you'd think we should all be trying to, but we are in fact all talking about trying to make the system safer, and yet there Italy seems to be resisting for kind of understandable reasons maybe. But
from where I stand, I don't feel to be on the wrong side. Quite the contrary. Let me state very firmly that probably there is no country in the European Union wanting to get rid of NPLs or excessive NPLs as quickly and as deeply as Italy is. And we have done a lot of progress, as you know, over the last 12 months or so. We have Italian banks have got rid of 25% NPLs after a period of no action, I recognize, in the previous years. The issue is not that. The issue is that the regulation in Europe, the introduction of BRRD, has come at a time and at a speed which were not consistent, in my judgment, with the fact that we had to get out of the crisis and a big crisis. Indeed, in the recent cases which Italy has dealt with, the two Venetian banks, we have tested the ground of the fact that still in Europe, from the banking management point of view or governance point of view, there's still a lot of separation between national jurisdictions, and there is still lacking a function of crisis management which historically has been there. Martin was mentioning one thing which I share very much about Mario Draghi's management of the central bank, doing what a central bank needs to do in terms of monetary policy, in terms of avoiding the breakup of the system. Well, in dealing with financial crisis, everyone who has read the history of financial crisis knows that there is an issue of crisis management, of lending of last resort function, which needs to be introduced in the system. Now, in my experience, what the introduction of the new regulation in banking, in the banking sector in Europe has done for a while is, in combination with the constraints and the limitations, which have their own right of being there in terms of state aid. Let's not forget that this is the combination of supervision, surveillance, and state aid regulation. This has de facto taken off the table of the European banking system a quote-unquote lending of last resort function. And many of the situations, critical situations that were dealt with in the recent past in Europe, I'm not talking about Italy only, I'm talking about Spain, for instance, with the Santander, although these are different stories, had to deal with, in practice, with the fact that we don't have such a mechanism yet. So we need to complete the banking union so that a lending of last resort full-fledged function is in place, and so that it will not be a problem if a single bank needs to be resolved. While as long as there are systemic impediments, if there is a problem with a single bank, there is a risk that this problem with a single bank, through contagion, gets propagated to the rest of the system. So, to make it a long story short, Italy is not on the wrong side of the river. It's crossing the river at a very high speed in terms of dealing with NPLs, dealing with a banking crisis which is the consequence of a 10 percentage points recession and 3 years recession in a bank-centric system, at the time in which the change in regulation, the introduction of BRRD, had made things worse and has taken away off the table instruments which were up to a moment before available for dealing with banking crisis, something which is different from the early Spanish banking crisis situation. So we need to complete the banking union, not only because it's a nice architecture, but because we have gone halfway to the river in all of Europe, not just in some countries, in terms of dealing with the architecture.
When you look at that coalition, the German coalition agreement, do you see some Do you have some optimism that the Germans are a little bit closer?
Well, I haven't read the latest version of the German coalition agreement. I admire the fact that in dealing with a coalition agreement, parties involved go in issues such as how to implement the common deposit insurance scheme, for instance. I would like to see some of that detail and debate in my own country's political debate, and I can assure you this is not the case. Having said that, I'm moderately optimistic on the fact that we can reach an agreement on how to implement in practice banking union, its full-fledged third pillar, the deposit insurance scheme, a topic for which Germans are very sensitive, be they belonging to one major party or the other major party with different nuances. And this is the result, in my view, not only of the fact that countries or governments understand better the rules, but because there is some experience which is showing that we need common solutions, number one, and number two, that there is much more mutual trust than there used to be in the past. So I tend to be optimistic for that reason. I hope this is reflected in the final political agreement in Germany. I hope this is reflected in fixing in practice instruments which are available in Europe today, but which needs to be tested, hopefully not against a big crisis, but against specific cases.
Martin, do you want the fact that the very small number, the relatively small number of people here, I suspect they're all people who are really quite interested in this subject, so they probably will want to have questions. But do you want to respond a bit on the banking?
Well, the Minister want to raise a question of the Minister, and then I'll make a comment on what I think is still needed, which actually bears very much on what you're concerned with as a banker. I think when you said there was no lender of last resort function, my understanding of what you're saying is that obviously the central bank has acted as a lender of last resort, as a classic liquidity provider. I think what you mean is that in a crisis there is historically a need for some fiscal engagement to deal with insolvency problems or perceived insolvency problems, which is lacking in the current structure, in the sense that member states can't do it and the collective can't do it. I hope I've understood you. Yes. Just to clarify it, because for many people here, the lender of last resort function is seen as a central bank function. This is a very important philosophical issue, because there is a view which I think I associate particularly with the former Finance Minister of the Netherlands, that such as fiscal engagement is absolutely unnecessary under all circumstances. And it's the same view as people who think that the TARP should never have happened. I happen to be with the Minister. But this is a very big philosophical issue which has not been resolved. Do you need fiscal capacity? The second thing, obviously, is the funding, and then we get to the reform, is the funding of the deposit insurance. The third issue, which doesn't come up often enough, I think, but is really very important, in any banking sector we know, which has a monetary area and therefore a government, there is a set of assets, or an asset, usually the liability, well, always the liabilities of the state, which are deemed safe. They are the liquid assets of the system. I tend to the view that the Eurozone needs equivalent assets for the banking sector to hold. Absolutely unimpeachable liquid assets. This is, in the current situation, you basically end up with holding the debt of one country or a few countries, or some very complicated composite has to be created. There's not much discussion. This is one of the reasons I always thought Eurobonds were needed. And I'll leave that aside. But what does a banking union finally mean in this context? And I won't go into the US comparison. The most important achievement of the US, and it took a long time, is that the problems of states or regional economies became separate from those of the banks that operated with them. In the 30s, by the way, that wasn't true at all. And it became established that essentially they were a federal concern. So you had a banking system that operated nationally, a solvent government which could borrow money, and therefore you can handle a banking crisis, which they showed. The Eurozone doesn't have that in all the various respects. And the And one of the reflections of that is that the banking sectors basically remain national. And that, as long as that continues, risk sharing through the banking sector cannot work. You need a banking sector which basically consists of Eurozone banks. Then it risk shares through the banking sector. And none of that will happen without a fundamental shift in the location of the other things that I talked about. So this question of the banking union is not some sort of technical issue which they can fix. There are some absolutely huge things that have to happen to make it work. And the final thing I wanted to say, again, why the Americans are relatively relaxed, is the capital markets just do much more in the US. They bear much more of the risk. And the capital markets are also extraordinarily small in Europe. That makes the banking sector even more important. And the fact that it is predominantly national means if any nation gets into difficulty, its banking sector will probably get into difficulty, and then we're back to where we started. So this agenda is absolutely vital if the next crisis is to be different from the last one.
And I bet if we carried on talking about that, we would also have to, we would not be able to avoid talking about Brexit, because actually in the context of this, to have the UK financial services and the main source of capital issuance in Europe actually no longer be as related to the broader economy would be quite a big
It would be strange to have a
flaw.
capital union centered in a foreign country. I once likened it to having Toronto as the financial capital of the United States. It doesn't seem likely, but they have no easy replacement. So it's a very fascinating thing to observe. The view of the British government that somehow it will continue to perform this function strikes me as a fantasy.
Along with many other fantasies. Questions from the audience? Yeah, in the front.
Yes, it is a question for Mr. Paduan. Chancellor Merkel just mentioned that she wants to go ahead with the banking union, and everybody needs to do its homework, mentioning separation, sovereigns and banks. What do you think about that? And in terms of de-risking the banking system, there is a lot of talk, understandably, about NPLs. But recently there was an interesting paper by some economists with the Bank of Italy about illiquid assets in banks' balance sheets, so old-style CDOs and so on and so forth. Do you think that de-risking should apply also to those assets, level 2, level 3 assets, for technical people in the room?
Thanks, Federico. Can I answer?
Yes, you may.
First of all, I fully agree with Madam Merkel that we need to address ways to further weaken the loop between sovereigns and banks' balance sheets. There's no doubt about that. How can that be achieved? To be very explicit, I am very concerned about, quote, artificial / compulsory readjustment of banks' portfolios, including sovereigns. So we must understand that if policy actions generate wrong signals to markets, markets will discount the outcome immediately and could trigger a self-fulfilling adverse mechanism of, rather than putting less risk in banks' balance sheet, they put more risk in banks' balance sheets. In other words, to be even more explicit, the limits to sovereign exposures, which are themselves possibly the positive result of portfolio choices, I find them full of risk if they are imposed with the wrong speed and with the wrong characteristics on banks' balance sheets, because we think that the optimal share of countries X sovereign in bank Y or Z balance sheet should be obtained for some reason. So let's try to put on the table policy prescriptions which go in this direction, which, however, take fully on board market reactions. Yeah, but this is what I find it lacking a lot in policy debates, that policymakers or regulators don't seem to understand how markets operate.
But just to push you a little bit on that, because you started by saying you do think it would be good to lessen the link. And yet, if that is the key conduit for the link, if that is what the main channel for the link has been, to say that you don't want to control it.
No. The less the link means
It can create a fiscal crisis overnight.
that the current state, if you take a snapshot of all banks' balance sheets in terms of their assets, in terms of their sovereign exposure, and you say, this is skewed too much towards that asset. And I may agree on case-by-case basis. This is one thing, and we want to change that allocation. The real point is about implementation. The real point is that I'm very concerned about measures that came out, say, tomorrow, over the next 6 months, Banks X must get rid of 50% of that sovereign's exposure.
So you preserve uncertainty so you don't have...
If
in
that
individual
happens,
cases.
not in the next 6 months, in the next 60 seconds, markets will discount and simply sell off that bank's assets.
True.
So you will destroy the bank rather than making it safer. That's my point. And I am really shocked by the fact that every time this argument is put on the table, there is no response. There's sorry to be so blunt, but this is really something that makes me nervous. The other point that Federico raised, I think it's extremely important. Yes, NPLs should be reduced. Other risky, quote unquote, assets in tier 3, in some other banks, not certainly Italian banks at most, should be dealt with as a source of risk. But strangely enough, or maybe not strangely enough, that is not very much in the debate. Every time one talks about risks in balance sheets, it's NPLs, namely Italian NPLs, and not tier 3 assets of other non-Italian countries. And this is not. This is something which should be fixed. If we want to reduce risk in the banking union, it should be the whole spectrum of risky assets to be considered.
Very quickly, question here, and then we're going to run out of time.
Yeah, hi, I'm a young global leader, and I run a venture capital fund in Central Europe, and I have just 2 related questions. The first one is very short. All the metrics that you mentioned are very optimistic, but if we take youth unemployment, we're still at 40% in Greece, in Spain, about 20% in the Eurozone. So what can you do to make this growth more inclusive for the young people? And a related question is, the youth is embracing cryptocurrencies and the blockchain also as a way to have crowdfunding sources for innovation. Are you planning to regulate that?
So maybe we should just have, also as a kind of final roundup of the panel, do you want to comment very briefly on maybe one of those, and highlight just one point, each of you, on the inclusive growth point, or the crypto, which I accept is a slightly different?
Yeah, it's a different one. I think that regulators, in the end, with respect to Bitcoin, but also other cryptocurrencies, presumably will get to a kind of regulation, because there's the other trend of transparency. So it has a technology behind it, the blockchain, which is accepted by everybody. But the intransparency is, I think, something which in the end regulators will act.
Martin?
Just youth unemployment, I agree with you. But it is important to note these figures are in a respect quite misleading. So if you take people under 25, because they're basically the proportion of people who are not in full-time education. And actually, in most countries, a very high proportion of young people are in full-time education. So what we are saying is that people who are not able to get into full-time education, or the less educated, unfortunately, are finding it very difficult to get their first jobs. And this is clearly true. And the solutions to that are obviously labour market reform, in part, but also actually to improve the educational system. Because I could perfectly well imagine a situation, I'm not saying it's ideal, I'm not saying it's going to happen, but actually pretty well everyone under 25 should be in education. And if they're not working, it wouldn't be the end of the world. And in which case, the solution would turn out not that everybody ends up in a job, but that actually they don't end up in neither a job nor in education, which is the really undesirable state. I have a very strong view on cryptocurrencies. We cannot live in a world, where a vast proportion of transactions are completely untraceable. We cannot. That is simply an open recipe for gangsterism. Sorry. That's my view. That is just simple human reality. And that's what happens. And finally, on the crucial thing, I think the really important point that Minister Padoan has made is there are two mistakes being made, I think, in the Eurozone. First, the ambition on the end point, how big the change has to be made to ensure that that we don't get back into another crisis like this it's really a large set of changes. And they're not small. Getting a banking union sounds nice. It's a really big shift. And the second thing is the steps to it have to be thought through very, very carefully, because if you do it in the wrong way, you will create crises, not remove them. And at the moment, I'm not sure that the senior policymakers in Europe are fully cognizant of either of those points.
Mr. Padron, I'll leave you with the last word, although it's going to have to be very brief. And then I will have one final follow-up. But
no, on cryptocurrencies, I share both views. I think they're both important from a financial point of view and from a broader security point of view. On youth unemployment, yes, this is certainly one of the most relevant challenges. We need both labor market reforms, including appropriate taxation policies to encourage hiring of younger people and education. But also, let me add that fortunately not in all countries, but in many countries in Europe, it's not just youth unemployment that's a problem, it's also women unemployment. And women unemployment, I discovered, is much harder to deal with effectively because it involves putting on the ground family policies, which are often very complicated and expensive. But this is the other big challenge, and sometimes they go together.
we haven't talked about something that is hanging over Italy, which is a certain election. And of course, there's some question mark among many of whether the kind of progress we've talked about could be derailed by a complete lack of certainty on the political front. And one of my colleagues said this morning, so what's the greatest risk to the Italian economy this year, non-performing governments or non-performing loans?
The government, I can tell you directly, will continue to perform, even if there is no new government in place, because this is what the government, as my Prime Minister Gentiloni says all the time, the government governs. I don't know whether that's good English or not, but
he said today that Mr. Berlusconi was not a populist. Do you agree?
Who's
your Prime Minister?
My Prime Minister. Then it must be true.
Thank you very much, all of you.
Okay, thank you.